Let's head into it. We received a few questions from the guests here, and why don't we tackle some of those? And then we kind of have a special edition here that we wanted to chat through. So the first question was the difference between ETFs and mutual funds. Colin, you want to take that? I'm happy to take it as well.
Yeah.
The mic.
I'd love to take it, actually. So yeah, John with another great question here for us to kick it off. So I think it's probably first best to zoom out and understand that ETFs and mutual funds or index funds, or when you hear these type of investment vehicles, they're actually a subcategory of a group-based asset, right? So when we think of, the mutual fund is the most common example of this, right? You think of grouping a bunch of companies together and packaging them as one investment. They have just, as we've become more sophisticated as investors, they have just created different iterations or different derivatives of those same type of investments. An ETF is just a different version of a group-based asset. ETF stands for exchange traded fund, and that's a clue to one of the biggest differences, or one of the, I guess, separating characteristics of what an ETF actually is. So just like a stock, right? So I'm in the Ohio office. So right now it's 2:07 p.m., right? The stock market closes at 4 p.m., right? If I wanted to buy a share of Apple Computer and I purchased that trade right now, it just turned 2:08. I would lock in that trade at whatever price Apple Computer is currently trading at, right? An exchange traded fund, an ETF, does the same thing, right? So if I bought an exchange traded fund right now at 2:08 p.m. Eastern Standard Time, it would lock in at whatever the price of that ETF is trading at in real time, right? The big difference between that and a mutual fund is that a mutual fund trades at what's called net asset value, or NAV for short. And that price locks in at the end of trading day, right? So if I purchased a mutual fund right now at 2:08 p.m., the trade wouldn't execute until 4 p.m. Eastern Standard Time, right? And whatever happens to the underlying assets in the mutual fund between now and 4 p.m., right? I'm going to purchase that mutual fund at net asset value. And again, that locks in at the end of trading day, right? If I went to dinner, right, and I thought, heck, I better go take, $5,000 more and purchase that mutual fund, and it's after hours, let's say 6:00 p.m. Eastern Time, that trade won't execute until the following day at close of market, right? So if I did it today at, let's say, 6:30 p.m., tomorrow at 4 p.m. Eastern, right, the trade would actually lock in. So that's really the big major difference between like a mutual fund and an ETF. The industry has really started to pivot that way towards ETFs, for that one big reason being that you can trade it in real time. It's a bit more liquid than a mutual fund, not by much, but for some people that it can make a difference. But again, I think that the real lesson here is knowing that, a mutual fund or an index fund, or in this instance, we're talking about an exchange traded fund. Those are all just subcategories of a group-based asset. So packaging a bunch of different investments together as one and issuing it to the marketplace, for them to have the ease of access to, many different companies or many different bonds or many different underlying assets, right? So if, Dad, Wes, if you guys have anything to add to that, that's really the big, at least in my opinion, the big differentiator between ETFs and non-ETFs. But it's a fantastic question, because I think ETFs are relatively new. And when I say relatively new, like the past 20 to 30 years, maybe we could split the difference there. Oh, okay. And John's chiming in as we're talking about that, the difference in fees between ETFs and non-ETFs, right? Another good question. ETFs definitely have become popular because they are, generally speaking, not always, but generally speaking, they have lower internal fees than many mutual funds out there, right? And we can really get in the weeds with the different share classes and the different group-based assets that you can invest in. and all types of fee ranges that they have internally. But generally speaking, again, not always, but generally speaking, ETFs are internally cheaper than mutual funds, right? It's a big reason that our firm has started to sprinkle them in. Many of you, probably all of you on this call, have ETFs in your portfolio, whether you know it or not. They just look a lot like mutual funds, right? So there's not a large difference in reporting on your mutual fund or your ETF, but some of the subtle differences, like again, they can trade in real time and they're typically internally cheaper, right? That can actually, those can actually be a big needle mover, particularly when we're talking about, long-term or long duration investing.
Yeah, and if it's okay, I want to add some things there. So there is some strategy that you can use with ETFs. Now, the challenge being that, let's say, an ETF can be more tax efficient, generally speaking. So you can use those as a strategy. We often do. The challenge with that, though, is let's say if you have an investment account that's taxable and they've had this investment account for 5, 10, 15, 20 years, and you want to make it more tax efficient, those underlying assets, but then you have to pay capital gains tax on the transitioning over from it. So like there's some hairiness to it, but I think long term it can really pay off depending on the fund or ETF itself. The other thing is you always want to do the net performance math. So we don't particularly care about what vehicle is used as long as it meets our net performance standards. So for instance, what does the cash flow look like? What does the net after expense performance look like? As simple as that sounds, it often is lost in conversations if somebody's just doing surface level research. So if you look at net performance, and that would be net of fees, it would be also net of taxes. So there's a calculation called tax equivalent yield, which is very, very, very important. And I could tell you 98% of the time when I'm talking with people and they're talking about different types of vehicles, very rarely are they doing those calculations. Tax equivalent yield, for instance, if you have a vehicle that is more tax efficient, and let's say it saves you on state, local, and federal taxes, well, then you have to factor that in, obviously, during your performance calculation. But it's quite shocking, actually, how often that calculation is not done. So you might have a tax equivalent yield of, or let's say a pre-tax equivalent yield of 3.5%. Well, depending on how many of those pillars of taxes it saves you on, it might enhance the net performance of that return, tax equivalent yield performance, to 5%, right, to 5.5%. It could be that significant depending on the tax breaks. So very important to put the portfolio through that lens as well. Joel, anything to add, bud?
No, I don't think I can materially add anything that moves the needle to what you guys just said. So that was well covered.
Yeah, and for the history nerds like myself out there on this, I'll take a quick sidestep here. The way that ETFs are taxed is actually slightly different than mutual funds. Mr. Cash, what's up, buddy? I'm not going to yell at you if you're being late. I'm happy that you're here. So, what's up, buddy? So the evolution of taxation on ETFs is actually pretty interesting because ETFs first started off as purely passive, so index funds, et cetera. And therefore, from my understanding, the tax legislation around it allowed for any capital gains that were inherently baked into the portfolio to be reinvested without being passed through to the client, to the end investor. So if the end investor doesn't need that capital, then there's an argument of using that ETF taxation structure so that the income is never passed to the client and therefore never taxed. Mutual funds would not allow that in most cases. Now, I think it was 2019 that the IRS said, okay, we now will allow that for actively managed ETFs. And that was like a big deal. That was a big deal in nerd investment world, because essentially what that meant is, well, hey, how much different is an ETF from a mutual fund, especially now that you're going to allow, in 2019, they allowed for that same taxation, like tax break, to be held inside of an actively managed ETF. So the world, to almost Colin's point earlier, is now meshing together, like, of ETFs and mutual funds, almost to the point where we've talked to some investment companies and they've said, like, they're not sure they're going to be making mutual funds in the future. Why not have it? Because a mutual fund, an actively managed mutual fund versus an actively managed ETF are very similar, to a large degree. Plus, you get the extra potential tax benefits. So a lot of these investment companies are saying, hey, we're going to really tilt our portfolios towards ETFs. So anyway, that might have been too nerdy in the weeds, but we have our eyes on it. And like Colin said, we are using them more significantly now. So I think we put that one to bed.
Let me
Sorry, Colin,
put a bow on that real quick. In about a month, Wes and I are meeting to actually talk to some portfolio managers about the ETFs that they that they have created and have trailed over the past handful of years, 10 years. The mutual funds that the companies have, they are now going to offer them as ETFs. So we are doing the homework on our end to make sure that we continue to add these types of vehicles to our clients' portfolios in the event that it's advantageous for you or the other people not on this call, right? So
yeah,
it's
we are literally. Sorry, go ahead.
No, it's a wave that we have kept our pulse on for the past handful of years or so. But one thing that's always been important to us is making sure we are not just jumping from asset class to asset class or investment vehicle to investment vehicle just because the headlines are talking about them or just because the media is talking about them. We want to do it based on the merit of their performance. However, ETFs have actually shown that they can be very beneficial at times, which again, that's why they are becoming a larger representation of our clients' underlying holdings.
Right. And in addition to that, just so you know, some of the work that goes on behind the scenes here, we're literally flying to New York. The meetings are literally at the New York Stock Exchange, where we get to talk to the portfolio managers in general to understand how their line of logic is, so we can communicate it with you guys. The other thing is you do want to be careful on there's a lot of ETFs out there that can get hyper specific. So you start to blur the lines between proper diversification and I would almost say putting into the gambling category. So I had a conversation with somebody last week, and it was like, hey, can we invest in a very small group of like this subsection of this subsection of this subsection of a niche? I mean, basically one step away from just investing in an individual stock. And this person is already deep into retirement. So you got to be really careful there on, hey, are you trying to gamble here, or are you trying to invest in the productivity of public companies? And you got to be really careful on that. That's a razor's edge. So ETFs, just like full warning, do allow more for that sub niching that might feel fun and sexy, and like it's got more like spectacular sort of headlines around it, but you just want to be careful for those types of things. All right, cool. So I think we put that one to bed. Any other questions? I think we had a fiduciary licensing question. So yes, we've got our fiduciary licenses. I do, Colin does. Joel used to, from my understanding, but Joel, I'll let you speak to that. I think he let some of his licenses drop just because what's the use of having 16 licenses floating around their office? But Joel, let me throw it over to you.
Yeah, exactly. I think and I hold all the insurance licenses in our office. So it's still the same requirement. You're supposed to do what fiduciary means, do the right thing for the client. One of the things that I know that's a buzzword in the industry, not that it shouldn't be, but it's, Bernie Madoff, for example, was a fiduciary, and we all know how he treated his clients. So it's really more of I think that's table stakes in today's world. Everybody is basically or should be a fiduciary. And that's just the bottom line requirement to be in this business. If you're not in this business to do what's the best thing for the client, then you don't need to be in this business. I mean, it's just pure and simple. But going back to that, we can't legislate morality. It's like, so fiduciary is really yes, it's a standard, and yes, you have to pass some tests to be able to call yourself a fiduciary, but it's also a hard issue. It's if you're not a good person, if you don't have the best intent for your clients that you're working with, then calling yourself a fiduciary is irrelevant. So I think by our actions, yes, we're fiduciaries. Again, I don't want to skirt around that issue and discount that, but I think by our actions, we should be proving that what we're doing on a daily basis in the planning with all our client base is for their best interest, not just to line our pockets or, make as much money as we possibly can. And then, the heck with the client. That's not, I don't think I hope we don't get viewed like that. I mean, because our whole goal is what's best for the client. How can we serve them best? And that's really the fiduciary standard.
Yep, absolutely.
I'd like to just add something real quick. It's easy to kind of point out the negative end of that, of like, oh, Bernie Madoff was a fiduciary. I can promise you this, and I think the folks in the California office know this better than anyone. The clients that had a relationship with Dave, he did not need to pass the test to prove that he was a fiduciary, right? I mean, his actions were just exemplified that, day in and day out, the way that he took care of the people that he served, right? So it had nothing to do with how he filled out a standardized test, right? A financial form. It had everything to do with who he was, the character, the man that he was. So I think that's probably a better guiding light as to how, the type of service that you're going to get, or, the type of person that you've engaged in a relationship with. But we totally understand the question, because, from the media side of thing, that gets blasted and beaten to the ground, right? Fiduciary standard, fiduciary standard, fiduciary standard. So it's not lost on us, why that question is being asked or where it's really coming from.
Yep, 100%. All right. Next topic. I wanted to throw this out, and I'm really excited about this because I love creating models and frameworks, and they always look like elementary pictures. Plus, I'm going to try to impress here. This might go down in flames, but let's see. Let me test this. Darn it. Oh, yes. Okay, there we go. So you guys now should have, so Jack knows, but for everybody else looking on my particular picture, we now have an overhead camera, which is probably not necessary, but it's fun as hell. So can you guys see this? Oh, yes, you can. Okay. All right. So a framework that I've been working on for a while and talking to clients is we always want to try to boil it down and simplify something. And I think we have a way now of simplifying like somebody's overall like wealth, portfolio. So the way that I envision it is you've got 3 castles, because I think a lot of people end up getting, marketed to and get the investment game like very confused. And we now at the office have, I don't know, what is it, Shelly, 50 years of data? Like I think like quite literally, like Dave was doing this for 54 years. And between Joel, Colin, and myself, we have so much data. So, but it's almost on a weekly basis, we'll get a phone call on, hey, should I do this extreme investment? Or there's this new gold shiny object out there, some version of that. But the best way I could summarize it is what we have seen, and guys, push against me if I'm wrong here, is basically 3 separate castles of wealth building. You've got your private business, and then you've got public companies, and you've got real estate. I think it's probably a fair statement that if we look at our investor relationships over time, right, they fall into these 3 castles. And then ideally, all 3 of these castles are paying you out cash flow. So you kind of have the king and queen of the kingdom here, right? And then ideally, you're working to build up those 3 castles. Now, you want to add a moat around those castles. So how do you protect the castles? And that's things like cash equivalent vehicles, right? Treasuries, high yield savings, money markets right now, et cetera, because interest rates have come back. But it's also things like estate planning. It's also things like, okay, does your family have a plan? I actually have a meeting tonight with a family, and they have a risk, which is they have a very large business. The husband does not have a succession plan. So that's like big risk number 1. But then big risk number 2 is there have never been any conversations around, well, what happens, God forbid, you pass away? So things like that to mitigate that, mitigate the risk around your castles, very, very important. So not only do we hedge recessions, we also hedge on, God forbid, if you pass away. I mean, how many families exist where only one of the spouses know what's going on in the finances? So that moat is something we're really harping on, especially coming off some really strong market returns over the last few years. we're telling a lot of our investors, hey, how solid is your moat right now? Because we don't know. At some point, a recession is going to happen. Another version of 2008 will happen at some point. We don't know if it's going to be next week, next year, 10 years from now, et cetera. But it's, what do they say? Like, make hay while the sun shines. I would also say protect the fort while the sun is shining. Now is the time to protect it if you haven't. So if anybody wants to have those conversations more in detail, let me know. But Joel or Colin, anything to add to that?
Yeah. First of all, that was the absolute worst drawing I've ever seen.
Dude, come on.
That
was
What
brilliant.
about his chicken/duck, if anyone's going to do a class?
It was a
Those were-
combination
those
of
were
abstract
terrible
and concrete
castles.
art is what that was.
Absolutely.
A goose? I don't know.
So, I think you bring up a fantastic point. What you're talking about is, where are the gaps in your financial plan? And they exist in, probably in order: estate planning documents, insurance coverage, and then what's your investment plan going forward. So the two boring ones and the ones that are more defensive would be estate planning documents and the insurance coverage. And then everybody wants to talk about the investments and have fun, because that's the offensive part of it. We grow the money and so forth. But without those, and I think we probably used this example before, but you kind of hinted at it, Wes. You got a business, or you've got a large investment account, or your house is worth a lot of money. You and your spouse are driving to dinner one night, and you, for whatever reason, you drift left of center, and you hit another oncoming car, and you kill the person in the oncoming car. Well, that person may have been a plastic surgeon who represented $1 million a year of income to their family. And, that $1 million times the next 15, 20 years is a significant amount of money. And if you're not protected, your net worth isn't protected by insurance coverage, then you've just lost everything that you've worked so hard for. So part of that moat is, and we always talk about the moat being cash or cash equivalents, and that's true. But part of that moat is protect yourself in estate planning documents, and then certainly protect yourself with proper insurances. And when we're talking about that, we're talking about homeowner, auto, and umbrella liability insurance. They're very, very inexpensive. I know certain parts of the area that are more expensive than our country, they're more expensive than others. But umbrella liability insurance, which is really what's going to cover you above and beyond auto and homeowner, really inexpensive. And, as a general rule of thumb, we probably want at least 2 times net worth of coverage from your umbrella liability policy, so that it protects you in the event of that black swan event, that unforeseen thing that it's Morgan Housel, I think. Risk is it happens when you thought of everything. All right, you don't know what's coming your way that could wipe you out in a second. And it would be shame on us, or shame on our planning process, if we didn't create the moat, not only with cash for a downturn in the market, but with protection in estate planning documents and insurance protection.
Yep. Well said. Completely agree. I think you had a question, buddy.
Yeah. How would you recommend keeping the uninvolved spouse updated with where everything is? Because I can see having this plan, putting it all together, and training the spouse on it, and then if not kept up with, like, regular training sessions once a year or whatever, I don't know what to call them, but 5 years down the road, they'd be like, forget everything and everywhere and everyone related to that.
Yep. Really good question. One of the things is, I have found spouses to feel obligated to stay awake during the conversation if we are involved. So use us. That's like literally recommendation number 1. Literally, the family I'm meeting with tonight is, I would put it in the extreme wealth category, and it's the same issue, which is why I'm like, we're having that meeting tonight. So the whole family has to pay attention and stay awake. I would recommend a family meeting like this, and we would be honored to participate with all of your families, of going through our template and our questions. And at least I would recommend, not at least, I would say once a year. Right. And some of these are really basic. Like, for instance, the amount of times where I've asked a family during these meetings, hey, mom and dad, you cannot speak. The kids, the beneficiaries, are only allowed to talk right now. Number 1, who's in charge of this? There's always a goose egg for the answer. Silence, crickets. Nobody knows the answer. Okay, if mom and dad were to pass away tomorrow, where are all the documents? Right? Nobody can answer. And that's if even mom and dad have documents, right? So I can go down the list. High level, what we'd recommend is number one, always verbalizing the plan with the family so you guys can talk through it. Number two, I actually really like having a one-page summary of the trust. And I've talked to several estate planning attorneys now. For some reason, it's not standard operating procedure to have a one-page, in human language, right, one-page summary of the trust. I don't know why it is, but it's not standard operating procedure for most estate planning attorneys. So therefore, even if your beneficiaries know that there's a trust and know where to find it, well, good luck for them interpreting 55 pages of it, right? Now, I know obviously they're going to take it back to an estate planning attorney to have it interpreted, but oftentimes it's just so easy, such an easy fix to have that one pager. What we recommend is, okay, have a one pager, 5 to 10 to 15 bullet points. Okay, in layman's terms, here's what I want to have happen with my money, right? Here's who's in charge. Super simple. And then if you can, just clear that with your estate planning attorney. And then I also like references. Hey, beneficiary number one, you're in charge. See page 2 or 3 for more detail. Really obvious, but there's not one trust I've seen that actually has that. And then item number 3, let's go through the protocol, like a quick fire drill. What happens? Mom and dad pass away. Now they can talk. Let's actually put a plan together and we document it. And number 4, we want to have 2 different sources. You want the paper source, but the problem with the paper source is as soon as you print it, right, it's out of date, especially with your publicly traded securities. So we also want a digital source. So for anybody who's not using eMoney right now with us, I'd highly recommend it. We pay many thousands of dollars a year for that access. We give it to all of our clients literally for free. So we house all of those documents for our clients. It's got their board of advisors in there. It's got everybody's contact information. It has your balance sheet, your net worth statement, et cetera, et cetera. Plus, we can also house your legal documents in there as well. So highly recommend it. And with your permission, we can also give access to your beneficiaries to that digital asset. So something to keep in mind.
Yeah, that last one's been massive value add for clients. Instead of, son, daughter, whoever the beneficiaries are, having to play Hansel and Gretel and string together the breadcrumbs to figure out where mom and dad banked, where they had their investment accounts, what insurance policies they had, where their estate planning documents. Most of the time when we meet with clients for the first time or early on in the planning process, they'll bring in a folder that looks like 5 dictionaries, stacked on top of each other. And like, hey, these are all my statements. It's like, well, good luck to the spouse or the beneficiaries, the kids, whoever it is that are left over the date of your demise. They have to thumb through all of those paper statements to figure out what bank accounts are still yours, what CD that you still have money in, right? Where the insurance policies are, et cetera. Right. So that digital source really cuts through a lot of the fluff for the beneficiary. So if nothing else, right, urge your spouse to at least understand how to access eMoney, or where the login, the username and password is for eMoney, so that they at least have the raw material of what's left over, and then come to us in the event of, God forbid something happens, we can we can get them up to speed on whatever gaps they still might have.
Love it. Outstanding. Okay. Sorry, go.
One other thing about eMoney, let's be practical here. So really there's 2 things about this. One is getting it set up the first time. And then the second part is the proper maintenance of it, right? Keeping it up to date. So I don't know, what would you recommend spending 2 hours every Saturday for the next, month or a couple of months until it's up to date? And then every month, spend 30 minutes keeping it up to date or something like that? What do you think?
Yeah, it's a really good question, and I think that's going to land on a spectrum. So I would say for most humans, probably once a quarter is probably the longest cadence that you want. For aliens like you and I, David is an engineer, right? It's probably a weekly basis. I mean, honestly, I hate even saying this out loud. I probably check mine every day. right? It's just one of those standard operating procedures. I want to make sure all my accounts are where they're supposed to be and there's no surprises. And I don't have much fun in my life. So it just depends on where you sit, right? I check my credit score, I think 2 to 3 times a week, and there's absolutely no utility in it for me. But for some reason, my alien DNA just likes it. So now that does come with a caveat. It depends on in eMoney how many accounts you have linked. Now, some like smaller banks or credit unions don't allow eMoney to link, so you have to do a manual update process. So like there's like sort of like edge cases like that. So it all depends on, you know, how much of your accounts are linked and automatically batch updated nightly.
Okay.
Cool. All right. Next topic, which is my favorite. Like, you guys are going to have to get me to shut up about this, because I think what oftentimes gets lost in the world of investing is, and because it's been made so efficient in the public markets, like, you know, you can invest in literally like Google, Amazon, Tesla, Microsoft, blah, 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 et cetera, so easily. Like literally, you can either make a phone call to us, you can hit it on your phone. It's crazy how efficient it is. And that's a gift and a curse. One of the curses of it is we get distant from actually what's going on, right? Remember that the style of investing that we recommend is all value-based. At its nucleus, it is a value transaction. It is a, hey, this company will provide you a good or a service for a certain amount of money in return. And in that sum of money, there's a given profit margin. That's the core of it. Everything else is to be built on top of that foundation. And this sounds obvious when we bring this sort of like conversation up to the surface, but it's not so obvious if you look at, let's say, for instance, big bubbles that have happened in the past. The one that I like to talk about is the tulip bubble. I think where is it, like in England or somewhere. This was generations ago, but a single tulip was worth more than 3 times the average household income, which I think in today's terms was literally a single tulip was being sold for about $150,000 in today's terms. That's crazy, but that's what can happen if you forget what investing, in our opinion, is, right? It is a value exchange. So I would heavily argue how much value you're getting in exchange for a tulip. Really what you're trying to do there is you're trying to buy a tulip so you can sell it for a higher price in the future. That is not what we recommend. Anyway, in the spirit of that, I think it's really important to have discussions on productivity of capitalism and how the world, in my opinion, is becoming better as a result of it. So there are some really cool big macro trends that are going on right now. So I want to test the waters on this because I spend a decent amount of time researching this stuff on a weekly basis, and I want to introduce it to all of you. Now, some of these, if not all of these trends, you're probably already aware of, but it's cool to kind of have a conversation around it and to put some numbers around these things. So always remember that your investments, whether it be real estate, your private business, or public companies, is going to jump up and down in price every day. Why? Because how much somebody is willing to pay for something that particular day is going to change the next day as compared to the day prior. But if you take a longer term view, right, and you look at, okay, how is capitalism or these companies or private businesses or real estate providing value to humans, and what do we see in the future? So there's some big macro trends that I want to talk about. Number one, if you look at the big sexy one right now, is AI, right? And I would actually evolve this conversation to be more pragmatic about it. It is a severe increase in computing power, like unbelievable. It is unbelievable the amount of computing power that is about to be released. And it, in fact, is in the process of being released. But how do we bring that down to a pragmatic level? Well, number one, if you look at, let's look at the healthcare space. If you look at the healthcare space, a lot of pharmacology and biotech is contingent on doing massive amount of computing. What used to take months, I just read this case study a couple months ago. There's one healthcare company, I'm not going to name their name because we're not promoting any companies here. One healthcare company, it used to take them months to do certain calculations. It now takes them minutes. Like that is a substantial increase in productivity because when it gets down to it, capitalism does one thing really well. It is incentivizing increases in productivity. And that, in my view, is the healthiest way to build wealth, to produce value. But I will pause there. Colin, would you mind chiming in on the AI revolution and the massive amount of increase we have in computing tech?
Yeah, so I just read something similar, Wes, actually in the healthcare space of it was something like a literal month that it would take them to do gene sequencing, right? To like just stumble upon solutions. They
Yep.
now have AI computers doing it 24/7, all day, every day. And they are getting matches on what are going to lead to cures to disease, autoimmune diseases, cancers, etc. They are now getting matches in this gene sequencing daily, right? So that is, you take it from months of nothing happening to now we have daily discoveries. And again, we are just in the infancy of this launching and taking off, right? Where AI, in my opinion, and your guys' guess is definitely as good as mine, probably better. But where I think we will see like tangible results from computing power and AI being introduced into our daily lives is specifically in the healthcare space. Just because of things that we're discussing here. I also think it's going to lead to a productivity boom that we might not be realizing as a consumer, as an economy right now, which will do wonderful things for maybe our national debt, our country as a whole, et cetera. It's easy to read the headlines and get distracted from the progress that America has made, not only in the past, 2.5 centuries, but even in the past 2.5 decades. But when you start to see that, you step back for a second and realize that, again, this is in its absolute infancy, and the best days of AI are very, very likely ahead of us. It's hard for me not to get excited and optimistic about the future, which hopefully is a refreshing take from mainstream news outlets. I see no reason why America's best days aren't ahead as opposed to behind us. And largely it's because of technology, right? And just the new wave that we're experiencing today happens to be in computing and artificial intelligence. But that's very likely not the last, right? So it actually instills a bunch of confidence and a bunch of optimism in me. And maybe that's the young spirit in me. But I am overwhelmingly positive on where this will take us, and definitely not ignorant to the turbulence that we will likely experience along the way, right? Whether it be like, actual danger in society or scams, right? One of the things that people are worried about with AI is the ability to replicate someone's voice, call a loved one, right? A family member, for example, and scam them, using this technology. Yeah, there will be bad actors. There always, there always has been, there always will be. But net of everything, I am going to be on the side of betting that AI is a tremendous benefit to society, and probably starting here in America first.
Yep, completely agree. One thing I want to add to the discussion here, it's really easy to see these macro trends because they're happening right now, but it's also, let's bring it down to a level that like really makes sense and we could probably all see as use cases in our families. I'll show you guys this. One thing I'm really optimistic about with the increased computing combined with the increase in hardware. So if I share my screen, if you guys haven't seen this, I think it's pretty fascinating. If I look at, there's something that we use in like the private equity market. It's called total addressable market, which means like what's the size and scope of a particular industry. If you look at what's called education tech, smart classrooms, et cetera, as you can see from this graph. Number one, we are already at probably at this point over $170 billion of current ed tech being used. This is predicted to grow by 2027, at least per this website, to 304 billion. I mean, this is wild. Think about every time you have a question or want to be educated in a certain area, we are continuously reducing the friction at which we can get that answer. So one of the frameworks to think through here is like, what happens in a world where everybody is 10x smarter, 100x smarter because they have a tech companion that can help them think through things? To that end, and I mean that sincerely, it's actually really hard to comprehend. Similarly, think about how hard it was to comprehend the value of your iPhone, right? It's actually still hard to comprehend. We use it so much that it blends into the background, but imagine if I took your iPhone away or your Android away, how, like, you'd probably notice inside of 10 minutes, which, funny story about that. My girlfriend's father, I've never seen him run ever. I saw him sprint 2 days ago because he thought he left his Android in the restaurant that we left. This is how important our technology is to us. Now, another piece of cool tech, if we look here, if any of you have ever had the wonderful experience of a family member calling you every single time they don't know how to use their computer or use their iPhone, and it can be incredibly frustrating. This piece of tech is really fascinating. So Meta, aka Facebook, paired up with Ray-Ban, and this is literally out on the market now. They have glasses. Now, the reason I'm bringing this up is because all historical tech of wearables on your face you look like you were in Star Trek. But now we're finally at the point where the technology has gotten small enough where the form factor looks normal. So if you look at these Ray-Ban sunglasses, like literally you could go to South Coast Plaza here in California, and you can go into the Ray-Ban store and you can literally buy these. So if you look here, there's cameras in here, which means that this piece of tech sees everything you see, every article that you read, every human that you interact with, etc. Right? Think about how much input that is and how smart a human can become if they have an AI assistant literally at their eyeball level. Also, there's technology around this curvature right here that uses bone connectivity to transmit audio. So you can have an AI assistant be telling you certain things inside of your ear, which is pretty crazy. So all of these things are fascinating in my opinion. Now, that leads us into in my opinion, the next big mega trend, which is robots. You have several different types of robots right now. I don't know if any of you have seen this, but this is really fascinating. This is Sparrow. It is Amazon's, it's probably about 2 years old now, I think. Amazon's intelligent robot. Amazon originally released a robot to do, this was years ago, to do the task that a lot of their employees didn't want to do, right? Like, think about repetitively picking up boxes for 8 hours a day. I mean, that very few humans on this planet would voluntarily want to do that. So Amazon got robots to do it. Their original robot, from my understanding, could do, it would take about 20 seconds for that robot to pick up a product. And it could only pick up, I think it was 50 different types of products. And it had a failure rate of 30%. Now, this robot Sparrow can pick up, from my recollection, 60 million different types of products, has basically 100% accuracy, and can pick up one product every 7 seconds. So this thing can work 24 hours a day, 7 days a week, 365 days a year. I mean, think about that level of productivity, which is why several of you, if not many of you, have probably had the same experience that I did this morning. I needed a new water filter for our water system. I ordered it. It's going to be waiting for me when I get home. That is insane. Like, that level of productivity. Now, with that being said, if we look at this, is really fascinating. Headline in Forbes not too long ago, Walmart drone finally approved in Dallas, Fort Worth. So I don't think these are currently live, but think about what, if this comes to fruition, what that will do, right? Drones literally delivering packages to people's doors. And from my understanding, the biggest piece there that was getting in the way was just the bureaucratic red tape of the government, which, hey, fair enough. I'd imagine there's safety issues, but apparently they've resolved those. And I think this is supposed to launch this year. And then finally, if we're talking about the robot revolution, have any of you seen this car? This is Waymo. So there's a huge discussion that's been happening over the last few years about autonomous driving cars, self-driving cars, etc. Waymo, if you go into Phoenix, Arizona right now, you will see these cars. Like, I've literally seen these in Phoenix, and I've literally seen these in Austin, Texas, and they are about to be released in Los Angeles. From my understanding, it's also in San Francisco. These are half the price of an Uber ride. Now, I know these bring up a whole bunch of debates and so on, but to deny the tech revolution And the stuff that's happening now, right, is just crazy to think about in terms of the productivity. So anyway, I will shut up. Joel, let me throw you the mic.
I think it's all good news. I think, we tend to think that artificial intelligence, we go to the negatives first, and, what could be the downside of this or the problems? It's going to destroy jobs, or somebody's going to use it for, some nefarious situation. But this is all good news for the investor, because we go back to what we're talking about when we just talk about investing in the stock market versus that's a generic term, investing in companies that create value. And these are the companies that are going to create value into the future. And as investors in long-term investments in the stock market, as we need to be, because we're living longer and we need our money to support us longer, this is just all good news for the investor, because the value creation going forward is going to propel the stock market higher and higher as time goes on, which only means that accounts are going up, income's going up. We're in a better position going forward. It's just, I don't see the downside to this. Obviously, there's going to be bumps and potholes along the way, but it's definitely on the other side of all this, it's all positive. We're going to figure this out, and on the other side of this is mass productivity.
Yep, exactly. And for some reason, I don't think I finished my thought on that one thing. Imagine if you're wearing those glasses, and God forbid you are single and you're a senior citizen and you fall, right? Having them attached to your face, right, will allow you to call 911 or call a family member right away. The Apple Watch currently already has a mechanism built in so that if it detects a fall, it will automatically call 911. These technological advances, yes, they come with their downsides, but I would say from a net perspective, the net benefit severely is categorically the winner. It's not even close. Colin, any thoughts on tech productivity?
Yeah, I think we just continue to pound the table. It's going to happen, or very, very, very likely going to happen, regardless of who wins the presidency in November, regardless if inflation stays persistent, regardless if wars continue to escalate, right, et cetera, et cetera. Amazon does not wake up and say, well, we better stop this sparrow robot if Biden gets reelected or if Trump gets elected, right? It's just not part of their DNA. It's not part of their psychology. It's not part of their thought process. And I only continue to beat that drum simply because if you turn on CNBC or if you turn on Fox News or whatever channel, right, happens pretty much unanimously from large media outlets, they are going to promote the fear that comes with these things, right? But at the core of it is Amazon separating boxes exponentially quicker and more efficient than they ever could with human beings, right? Or Meta, Facebook, right? Helping us be more integrated with technology in our everyday life, right? Or drone packages coming to our doorstep, so on and so forth, right? So I just urge you to always remember, it's easy to get sucked into these black holes of, oh, the inflation print, or who's the president, or what's happening in these economic forecasts. Those are never-ending black holes that will not make you a better investor, right? That's something that I feel very confident about. And if you can turn your psychology to, hey, what value are these companies that I'm investing in, or this real estate that I'm investing in? What value is it providing the marketplace? That's a much better lens or a much better filter as an investor to weed out the noise and stick to what will actually be beneficial, materially impactful for you and your family.
Yep, absolutely. And then just to wrap things up here, a few other very large trends to keep our eyes on over time. Air travel, apparently there's still 2 billion people in this world who have not traveled on an airplane. So think about how much, like, when our technology becomes so efficient and cost efficient where you can get people to travel to different locations. 2 billion people, like, that's wild. The next one is, and I know this is going to be unpopular, these two topics in particular, energy, really big category right now of a mega trend, because you have very high demands in the future. You've got increasing EVs, electric vehicles, and then number two, you've got I think the data centers for this tech are going to demand a lot of energy usage. So if you look at the subcategories or the providers of those energies, it's going to be a combination potentially of wind, solar, oil, and then but also the big thing that's being talked about a lot right now is nuclear. Now, I know it's hard to have these conversations because this is also like integrated into politics, but just something that we're noticing is a big conversation right now. And if I had to weigh in on that, like my 2 cents, the limited amount that I know seems like nuclear is a pretty reasonable option, especially now that we've got the technology to reduce the historical risk that we've had in the past. So, and then the final trend is, what do they call them? Is it GLP-1 drugs, like the obesity drugs? Now, despite our feelings on it, my feelings in particular, like I'm a fan of, hey, just eat properly and go to the gym, et cetera. But the reality is, if you look at the data, most people have historically not been able to do that. So when you have these medical interventions, the Ozempics of the world, et cetera, I mean, it's showing some substantial benefits. It's also showing some side effects, obviously, but I wouldn't be surprised if that trend continues in a big way. And if you look at something like cardiovascular disease, the #1 killer of men, how can we introduce pharmacological advancements to reduce those? So anyway, I'll pause there. Joel and Colin, anything to comment on those final trends?
Dad, do you have anything?
No, I think it's a fascinating subject. I think we could be on it for another hour, but people probably have things to do today. So if you have anything, go ahead.
Yeah, you probably want to just be a fly on the wall of Wes and I's like private conversations when we talk about Ozempic and weight loss drugs and whatnot. I'm not going to bore you guys with that today, but we could talk about it probably for another 30 minutes or so. Yeah, I think these are fun topics. Hopefully you guys get enjoyment out of talking and working through some of these things. I do think these roundtable calls make us all better investors. And at the very chance, this is kind of like a town hall, or a place where we can talk out some of these things that you hear at the water cooler at work or you hear on the television, et cetera. And hopefully as a community, we can weed through what's important, what's not, and focus on the big trends that actually are meaningful or impactful in our everyday lives and forget the rest.
Yeah. And to that end, remember like the whole Warren Buffett quote of a rising tide raises all boats. One of the reasons we want to talk about these trends is like, you always have to, it's hard to remember that when, your neighbor is telling you the world's going to hell in a handbasket, remind yourself of these things. It's like the world is mathematically getting better. Like anybody who argues that is not bringing proper data to the table. It doesn't mean that there's not pros and cons. It doesn't mean that at all. But to think that the world is not getting better, that poverty is reducing, that children are being educated at a faster rate, that they're giving tech that they would have never had access to before all over the world, that isn't, in my opinion, that is a conversation being had absent the data. So we want to try to bring the data to the table. Joel, any final words of wisdom, buddy?
No, I think that's a great thing. I think we take another analogy to that. Our job, if you bring it to like a church analogy, our job is to get the flock safely to the destination, right? And a lot of the responsibility that we have would be to help people tune out the noise that you're talking about, because there's always going to be, you think about the things that were going to end the world on the news last night. Well, 4 weeks ago, they weren't talking about those. They were talking about something else that was going to end the world. And then 4 weeks from now, we'll be talking about something different. And the fact is the world didn't end on any of those occasions. So our job is to kind of keep their eye on the prize, keep everyone focused on the ultimate goal, and just tune out that noise. And I think we'll all be better investors for it.
Heck yeah. Colin, any final words, buddy?
Yeah, well, today's conversation was a result of a handful of really quality questions that we got prior to today's session, and then some just live interaction from you guys today while we're on the call. So if there's anything else that you want to bring to the table for next month's roundtable, I would encourage you to pose those questions to us so that we can hopefully have and intelligent back and forth on things that, believe me, it's not just you thinking these things. We get a lot of repeat questions from multiple clients. So those are helpful in making sure that the topics are topical and still relevant and adding value. So thanks again.
All right. And final thing for our entertainment portion of this discussion, Jeff Cash here on the call is going to tell us some knock-knock jokes that he has prepared. Jeff Cash, please go. You're ready. Just kidding. Terrible dad joke. Love you guys. If you have any questions, reach out to us and we will talk to you soon. See you guys.
Thank you,
All
everyone.
right, thanks, guys.